All right, welcome back to the channel. Today I'm going to talk about my allocation for 2024. So let's get right into it. A couple of weeks ago when I was doing my year-end review, I mentioned that I was giving serious thought to what I'm going to do once I got out of some of the leveraged funds that I was in coming into the end of 2023, and that I would put up my decision and what I'm going to be doing going forward. So I've given it a lot of thought, and I have an allocation that I am happy with and I will be implementing over the next several weeks. So let's go ahead and just take a look at it. If you recall, my allocation for the $1 million portfolio is essentially 50% equities, 25% bonds, 15% gold, and 10% REIT. Now, within those broad asset class categories, I'm picking very specific funds, ETFs, that will go into those buckets just to give it a little bit more of a juice on the returns. So for the equities, instead of using a total stock market ETF, I'm using the NASDAQ 100, which is primarily technology growth stocks, although it's not entirely all technology, but for all intents and purposes, it's large cap growth. You can do a total stock market in there and it'll be fine, but I just chose to do large cap growth. In terms of the bond allocation, I decided to go with long-term treasuries. Now, long-term treasuries can give you a little bit more capital gains if the interest rates were going to go down. That obviously hasn't happened in the last 2 years as we've been fighting inflation, but because the duration is a lot longer, it's a lot more sensitive to interest rate movements, either up or down. So in the last 2 years, we've had rates go up dramatically, which means that the price of the TLT long-term duration ETF that we're holding has gone down significantly. But if you've been rebalancing, you should be fine. But I chose TLT or long duration bonds because I do want to be more exposed to the capital gain side of the bond movement if that happens. In terms of the third asset, that's gold, and I put 15% there using GLD. Now 15% is on the high side. The recommendation is between 5 and 15%. And the point of having gold in the portfolio is not that it's necessarily an investment because it's missing some of the characteristics that makes an investment. The main one being that gold does not give it any kind of cash flow. It just sits there and the value of that asset fluctuates. So there's no argument that it is an asset and it has value and it holds it reasonably well. But more importantly for what I'm doing, I want it to be in the portfolio because it's very volatile. And the key here is that volatility doesn't quite move with either stocks or bonds. So when it comes to rebalancing, it forces me to sell things that have gone up, whether it's the bonds or the equities, and then buy gold. And vice versa, if we were in a market environment where stocks have gone down dramatically and bonds are in distress too, and gold has gone up, as what we saw in 2023, it will force me to sell gold when it comes time to rebalancing and then bring things back to equilibrium. And then lastly, the fourth slice of the pie is a REIT. And I'm actually using either Realty Income Core, or the Schwab Dividend ETF. Now, the Schwab Dividend ETF is based on the Dow Jones Dividend Index, but the reason that I use SCHD, the dividend ETF, is that dividend stocks are large cap value play, and they are remarkably similar to REITs. So even though a REIT is not exactly like stocks, it has a lot of those characteristics and it approximates large cap value very well. The reason that I did decide to split it into a SCHD for new money is that Realty Income Core is a single company. It's a company based in my hometown in San Diego. They've done great over the last couple of decades. They've consistently paid dividends, and a pretty healthy one at that, on a monthly basis. And in fact, I think their tagline is that they are the monthly dividend company. And as far as I know, they've maintain a very good track record. I decided to switch to the Large Cap Value ETF using Schwab's Dividend ETF, mainly for diversification purposes. Although Realty Income has been around for a long time, you never know what's going to happen with the future, and having just one company is another risk. And I just feel more comfortable just spreading it out to a basket of companies using the Schwab Dividend ETF. So that's what the allocation has been for the last couple of years now, if you've been following along. What I've decided to do, and I've gone back and forth for 2024, is that I really question myself in terms of whether the NASDAQ 100, which had stellar gains in 2023, I think it was like 53%, if you just bought it at the beginning of the year and just held on for the ride, right? So the question going through my mind was, after a year of 50+% return for the NASDAQ 100, how likely is it that it's going to provide good returns in 2024, the following year? And that's a really hard question to answer. There is a side of me that says if something has gone up 50%, the valuation of it is pretty rich. And you know, for all intents and purposes, it is rich, but it's not completely out of whack. I think that it may be 10 to 15% higher than the fair value. So it's not crazy high, even after, you know, a great 2023. Now, part of that is that 2022 was just dismal, so it's almost like recovering back to the previous level. So there was that debate in my mind about, should I go with, you know, less allocated to growth stocks because they've gone up tremendously in 2023 or not? And then the other big thought that went through my head was that we know the Fed has been raising rates like crazy, like the fastest it's done for decades, right, to fight inflation. And for all intents and purposes, it seems like the fight is mostly won. Is it completely won? I don't really know. There's talk that they may have to do one more rate increase before they're completely done. The market doesn't think so. In fact, some of the market participants are thinking that rate cuts can start as soon as March of this year. That's 2.5 months away. What do I think about all that? I really don't know. What I do know is that I feel like we are almost there, almost winning the fight. It's as if you're flying an airplane and you can see the airport. There may be some turbulence and crosswinds as you're trying to land, but a soft landing is entirely possible. So my thinking on long-term bonds is that even if there was another, say, 25 basis point increase before they're completely done, it's still okay to hold it, right? Because even if rates go up a little bit, your capital value will go down. But at some point when inflation is at their 2% target or close to it, maintaining the Fed funds rate, which is currently at 5.25% to 5.5%, is not sustainable. It would be too restrictive of a monetary policy, and the Fed doesn't want that either, because if you're too restrictive, you can actually cause a recession. What the Fed really wants to do is maintain a neutral interest rate to promote growth and unemployment as low as it can go. That's kind of their dual mandate, is to stimulate the economy to the proper degree, maintain price stability, but keep the employment picture in mind as well. So my thinking is that the Feds will lower the rates in 2024. I don't think they're doing it in March. They may have one rate increase in the early part of the year if they were going to do it. But if they don't, they will have to start reducing rates. Now, is it 2 cuts or 3 cuts from the end of the rate hike cycle? We don't know. Most people are thinking 3, including several Fed governors. That seems appropriate because if inflation was really down to around 2%, their target, that means that getting rates down to maybe 3% overall from where it is now would be appropriate and would be a neutral rate. Now, they're not going to go from 5.5 or 5.75 if they were going to raise rates down to 3 that quickly. But they have to move in measured steps. And I feel like 2 to 3 rate cuts this year, some point, is more likely than not. And if I was betting, and in a way I am because I'm putting my money where my mouth is, I'm betting on those rate cuts coming. So bottom line, I'm sticking with my allocation for the most part, sticking with long-term bonds, but making a couple of tweaks. So what are the tweaks for 2024? Well, if you take a look, I'm maintaining my equity, growth equity position at 50%. I'm maintaining the long-term duration bonds at 25%. I'm reducing my gold allocation from 15% in 2023 down to 10%. And then I'm taking that 5% that's freed up and adding it to the Schwab dividend or realty income bucket. So this is the large cap value play or the REIT. So that's one small change that I'm doing. And if you're happy with my reasoning so far, you can stop right here and just make that minor change, and then you're good to go. But if you're crazy like me, I'm taking it one extra step further. It doesn't mean that you have to do it, but this is what I'm doing. So keeping to that allocation, I'm introducing 2 new ETFs. These are leveraged ETFs. And the purpose of using these leveraged ETFs is to squeeze a little bit more returns out of my allocation. But it's not a free lunch. It comes with quite a bit of risk, and you should understand those risks if you're going to do this. Now, like I said, if you're not crazy like me, you could just stick with that high-level allocation where I reduced the gold allocation just a bit, added that bit to the large cap value, call it a day. But if you're adventurous, this is what I'm doing. I'm taking that 50% allocation to QQQ and splitting it up so that I'm now buying 15% of the TQQQ. We call that the triple Qs. This is a direction 3X bull NASDAQ 100, right? There's an SQQQ if you're going to short the NASDAQ 100, but that's like a triple short on the other side, right? We're not doing that. I'm going long, but the reasoning for doing this is because I think that you can still get a positive return out of the NASDAQ in 2024. Now, will it be 53% like we saw in 23? Not likely. Will it be 20%, 18%? Again, probably not likely. It's probably going to be down in the low double digits if we get there. Now, if we do, and I want a little bit more return, I'm happy to split that 50% allocation so that a little bit of it is on the 3X leverage side. The risk of that is that you're going to have a lot more volatility because you're introducing something that moves at 3 times what it's tracking. The expense ratio is a little higher. It's not crazy, especially when I'm using it just as a small portion. But the double-edged sword here is that if I'm wrong and the NASDAQ does go down in 24, then that 3X is going to work against me, right? But if you understand that and you're accepting of it, go for it. I'm doing the exact same thing on the long-term bond side. So I'm taking that 25% allocation of long-term bonds and splitting it into 15% TLT and then 10% TMF. TMF is basically the same thing as TQQQ. It just happens to be the triple leverage of the TLT. All the things I said about the triple Qs apply here to TMF, the increased volatility, a little bit higher expense, and if things don't move the way I expect it to, like we do not get the rate cut, then it's going to hurt a little more in 2024. But as I promised, this is the video where I kind of go into what my allocation is going into 2024 and the reasoning behind it. Now, you are free to disagree with my reasoning. I think it's a reasonable thesis for the coming year, and I'm happy to bear a little bit extra risk for a little bit of extra return. That's one of the fundamental laws of investing. There is no returns without taking on a little bit of risk. So there you have it. this is my allocation going into 2024. Thanks for watching and sticking around to the end here. This video is a little bit technical on the reasonings on why I do what I do, but hopefully you find value in it. So if you did, please leave me a like, tell your friends about the channel, and wish you luck in your investing journey for 2024. And I'll see you in the next video. Later.